$14,000 per year, and most retired Americans have no idea this is happening to them. That number is not made up. That is the average amount in extra taxes and lost benefits that working retirees over 65 pay every single year, simply because nobody told them the rules had changed. Not their employer, not their financial advisor, and certainly not the IRS. If you are still working past 65, whether part-time or full-time, whether by choice or by necessity, you are living inside a tax system that was not built for you. It was built for people who either fully retired or never retired at all. You are somewhere in the middle. And that middle ground is exactly where the IRS collects the most money from people who least expect it. You may be collecting Social Security. You may have a pension. You might be drawing from your 401k or your IRA. And on top of all of that, you are still earning a paycheck. That combination, wages plus retirement income, triggers rules that your employer's payroll department does not know about, rules your HR person has never had to explain, and rules that most tax preparers only learn after they have already cost a client money. This is not your fault. The system is genuinely complicated for people in your exact situation. But here is the hard truth. The IRS does not care whether you knew the rules. They only care whether you followed them. And the penalties for not following them are real, they are legal, and they are coming whether you are ready or not. So before this year's filing deadline, before your next paycheck arrives, and before you make one more financial decision in retirement, you need to understand exactly what the IRS is allowed to do to you, and what you are allowed to do back. Here is what the IRS can legally do if you are over 65 and still working, and you get the rules wrong. First, they can tax up to 85% of your Social Security benefits. This is not a rumor. It is written directly into the Internal Revenue Code under Section 86. Once your combined income crosses a certain threshold, the IRS does not just skim a little off the top. They take a significant portion of what you thought was safe income. Combined income, by the way, means your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. That number decides everything. If you are filing alone and that number goes above $34,000, up to 85% of your Social Security is taxable. If you are married filing jointly, that threshold is $44,000. Most working retirees blow past those numbers before February is even over. Second, the IRS can force you to take required minimum distributions even while you are still working, in most cases. These are called RMDs. They are mandatory withdrawals from your retirement accounts. Under the Secure 2.0 Act, which became law at the end of 2022, the age at which you must begin taking RMDs was raised to 73 if you were born between 1951 and 1959, and to 75 if you were born in 1960 or later. But here is where most people get blindsided. If you have an old 401k at a former employer, that account is not protected just because you are still working somewhere else. The still working exemption only applies to your current employer's plan, and only if that plan allows it. Miss an RMD, and the IRS charges you a penalty of 25% of the amount you should have withdrawn. That penalty used to be 50%. Secure 2.0 lowered it, but 25% is still a painful number. Third, the IRS can reclaim money through something called a tax withholding shortfall. If your employer is not withholding enough taxes from your paycheck to cover the taxes on all your income, wages plus Social Security plus retirement distributions, you could owe a large lump sum in April. And if you owe more than $1,000 that was not withheld during the year, you may also owe an underpayment penalty under IRS Form 2210. That penalty is calculated quarterly, not annually. That means the longer the money was short, the bigger the hit. Most people do not know this because the rules for working retirees exist in a gap. Think about it. When you are young and working, your employer handles most of your tax burden through payroll withholding. You file, maybe get a refund, and move on. When you are fully retired, your financial planner or your pension administrator often sets up automatic withholding on your distributions. Again, mostly handled for you. But when you are doing both, earning wages and drawing retirement income, no single system is set up to manage the full picture. Your employer's payroll system only sees your wages. Your IRA administrator only sees your IRA. Nobody is looking at the combined number. Nobody except the IRS, who looks at all of it on April 15th. This is what I call the gap tax. It is the tax that lives in the space between two systems that were never designed to talk to each other. And the IRS has never had a reason to make this easier to understand. Confusion benefits collection. Complexity benefits the system. Clarity benefits you. And that is why you are watching a video like this instead of getting a letter from your accountant explaining exactly what to do. There are financial professionals who know these rules deeply and explain them clearly to every client. There are also financial professionals who only encounter working retirees rarely and who miss these issues entirely until after the damage is done. The rules exist. The information is public. But public and accessible are two very different things. Now let us get into what you actually need to know. We are going to cover this in 3 clear sections. Each one is a rule, each one has a dollar example, and each one has a specific action you can take. The first rule is about Social Security taxation and how your wages change everything. If you are collecting Social Security and you are still earning wages, your combined income calculation can jump fast. Here is a real-world example. Say you receive $20,000 per year in Social Security benefits. You also earn $30,000 in wages from your part-time job. Your adjusted gross income from wages and other sources is $30,000. You add half of your Social Security, that is $10,000. Your combined income is now $40,000. You are filing single. That puts you well above the $34,000 threshold. The IRS now taxes 85% of your Social Security. That is $17,000 of your Social Security that becomes taxable income. At a 22% tax rate, that is an extra $3,740 you owe that most people never plan for. What should you do? First, run this calculation before the end of each year. Use IRS Publication 915. It has the exact worksheet to calculate how much of your Social Security is taxable. Second, consider asking your Social Security office to begin voluntarily withholding federal taxes from your benefit payments. You do this using IRS Form W4V. You can choose to have 7, 10, 12, or 22% withheld. This one simple form can prevent a surprise bill in April. The second rule is about Medicare surcharges and how your wages can trigger them 2 years later. This one shocks people. You might think Medicare is a fixed cost. You pay your premium, you get your coverage. That is it. But that is not how it works once your income climbs above certain levels. Medicare Part B and Part D premiums are income-based. The surcharge is called IRMA, Income-Related Monthly Adjustment Amount. Here is the part that catches people completely off guard. Medicare uses your tax return from 2 years ago to set your current premium. So if you worked overtime in 2024, or took a large IRA distribution, or sold a property, your Medicare premium in 2026 could jump significantly. Here is a concrete example. In 2025, the standard Medicare Part B premium is $185 per month. But if your income from 2023 was above $106,000 as an individual, your 2025 premium jumps to at least $259 per month. At the highest income levels, it reaches $628.90 per month. That is a difference of more than $5,000 per year, just for Part B alone. Add in Part D surcharges, and you can easily pay $6,000 more per year in Medicare costs than a lower income retiree. What should you do? If your income drops significantly in the current year, because you reduced your hours, retired fully, or had a one-time income event that will not repeat, you can appeal the IRMA surcharge. You do this using SSA Form SSA 44, which stands for Medicare Income-Related Monthly Adjustment Amount. You submit it to Social Security, not to Medicare. This is a form they will not advertise to you, but it exists specifically for this situation. Do not wait. File it as soon as your income changes. The third rule is about withholding and how to fix it before the IRS does. When you are working and collecting retirement income at the same time, your tax withholding is almost certainly wrong, not because anyone made a mistake, but because the standard W-4 form that your employer uses was designed around a single income source. It does not account for Social Security. It does not account for IRA distributions. It does not account for pension income. Here is a real example of what happens. You earn $25,000 in wages. Your employer withholds taxes based on that $25,000, but you also receive $15,000 in IRA distributions and $18,000 in Social Security, $15,300 of which is taxable at the 85% rate. Your actual taxable income is closer to $55,000. Your employer withheld taxes on $25,000. You now owe taxes on $55,000. The gap between those two numbers is where your unexpected April bill lives. At a 22% effective rate, the difference in taxes owed versus taxes withheld could easily be $6,000 to $8,000. What should you do? Submit a new W-4 to your employer. On line 4C of the W-4, there is a box called Extra Withholding. This allows you to request an additional flat dollar amount withheld from every paycheck. If you estimate you will owe an extra $4,800 at year end, you can request an extra $200 per month to be withheld starting now. This is one of the most underused tools in the entire tax code. It is simple, it is legal, and it puts you back in control. Here is what you need to do right now. Work through these steps before the end of this quarter. Step 1. Calculate your combined income today. Add your adjusted gross income to half your Social Security benefits. Compare that number to the $34,000 threshold if you file single, or the $44,000 threshold if you file jointly. If you are above those numbers, up to 85% of your Social Security is taxable, and you need to plan for that bill. Step 2. File IRS Form W-4V with your Social Security office. Request voluntary withholding from your Social Security payments. Choose the withholding percentage that most closely matches your tax bracket. This one form prevents one of the most common surprises that working retirees face. Step 3. Submit a new W-4 to your current employer. Use line 4C to request additional withholding per paycheck. Base your additional amount on the estimated gap between your wages-only withholding and your total estimated tax liability. Step 4. Check your Medicare premiums for the coming year. If your income this year is substantially lower than it was 2 years ago, file SSA Form SSA 44 with your local Social Security office. Do this by October 15th of the year before the new premium takes effect. You may be entitled to a reduction, and the only way to get it is to ask. Step 5. Locate and review IRS Publication 554. It is called the Tax Guide for Seniors. It covers age-based deductions, the higher standard deduction available at 65, and special rules for retirement income that most working retirees never read. It is free, it is updated every year, and it was written specifically for people in your exact situation. These steps are not complicated. They do not require a law degree. They require about 2 hours of your time and a willingness to look at numbers that most people are afraid to face. But fear is expensive, ignorance is expensive, and the IRS is very patient. They will wait until April to show you the full bill. You now know more about the tax rules for working retirees than most people who have been in this situation for years. You know about the Social Security combined income threshold. You know about IRMA and the 2-year look-back. You know about the withholding gap and how to close it. You know which forms to file and when to file them. This information changes everything, not because it is secret, but because now it is yours. If you found this useful, subscribe to this channel. Every single week, I cover what the IRS expects from retirees, the rules most advisors never explain, the forms most people never file, and the money most retirees never know they are leaving on the table. Hit the bell so you do not miss the next one, because the rules keep changing and the cost of not knowing keeps growing.